Stop scrolling. If you blinked today, you missed it. Silver didn't dip. Silver got ripped. In 4 hours, we went from $96 to $91. That's not a normal pullback. That's a flash crash. And the trigger wasn't a chart pattern at first. It was a headline. Welcome back to Sam Invest. I'm going to break this down like a crime scene. What the Greenland deal headline actually changed in the market's brain, how $96 turned into a hard ceiling and why $94 was the trapdoor, what the next 24 hours decide, correction or trend reversal, and the checklist you need, levels, signals, and what to watch next. Quick note, this is market analysis and education, not financial advice. Manage risk. For weeks, silver has been trading with something extra glued on top of the price. Not fundamentals, not jewelry demand, not even inflation. A risk premium, a fear premium. The market was pricing in one big thing: escalating geopolitical tension around Arctic trade routes. The kind of tension that turns shipping lanes into bargaining chips and tariffs into weapons. When fear is high, silver behaves like a bunker. Capital hides in it. Funds hedge with it. Traders chase it. So the rally kept getting fuel. Every dip was bought, every breakout got cheered, until this morning. Because this morning the tape changed its story. We got reports of a diplomatic framework, call it a Greenland deal, a de-escalation package, a pathway to cool the Arctic standoff, and the second traders believed conflict risk was shrinking, the market did what markets always do. It rotated out of defense and back into offense. That means money leaves silver and runs into broader risk assets, equities, high beta, anything that benefits from the world is okay again. So silver didn't just fall because people stopped loving it. Silver fell because the reason it was being overowned vanished in minutes. Here's the part most people miss. Price doesn't move like this because everyone calmly sells. Price moves like this because positioning breaks. At $96, silver wasn't just expensive. It was crowded, it was leveraged, it was loaded with stops. So when the headline hit, the first sellers weren't humans. They were machines. Algos read the shift in risk sentiment, the volatility spike, the flow reversal, and they hit the sell button into thin liquidity. And when liquidity is thin, every market order becomes a hammer. That's why it felt like a trapdoor. You weren't watching a slow unwind. You were watching a domino line get kicked. Now let's talk charts, because the chart did warn us. It just didn't tell us the exact minute. $96 is a psychological level, a billboard number. It's where traders take profit, where late buyers hesitate, where market makers love to fade the crowd. We tagged it, we kissed it, and we got rejected. That is classic behavior at a round number, especially after a vertical run. But the rejection alone doesn't create a $5 waterfall. The waterfall happens when the market slices through a level that everyone is using as a line in the sand. And that line was $94. $94 wasn't just support. It was a clustering zone. It was where dip buyers had been stacking bids. It was also where a lot of stop losses were hiding under the floor. So when the price cracked $94, two things happened at once. The dip buyers backed away because they don't want to catch a falling knife, stops fired, because protective orders convert into market sells. That's the waterfall effect. Stop triggers, forced selling, lower price, more stops, more forced selling. And when the market is over-leveraged at record highs, this cascade is violent. So the move from $94 to $92 didn't feel like selling. It felt like liquidation. Why $91 matters right now. $5.55. Now we're testing $91. And this is where the story splits into two timelines. Timeline A. This is a temporary correction. Silver holds above $90, finds buyers, volatility cools, and the market rebuilds a base. Timeline B. This is a trend reversal. We lose $90, the chart flips from buy the dip to sell the rip, and the rally becomes a memory. So today's close matters. Not the wick, not the headline. The close. Because institutions judge closes. Weekly closes even more. Let me be clear. The long-term silver case didn't evaporate in 4 hours. Industrial demand is still real. Green energy tech still eats silver. Solar, electronics, power grids, EV components. That demand is a structural floor under the metal over time. But today's crash wasn't about factories. It was about fear. The fear trade is on pause. That's all. And when the fear trade pauses, leveraged longs get punished first. So you can believe in the long-term story and still respect the short-term damage. Both can be true. Now zoom out one more layer. Watch the US dollar index, the DXY. When the DXY rises, it's like gravity on metals. Not always instantly, but the pressure is real. If the geopolitical de-escalation narrative pushes the dollar higher because markets feel safer holding dollars, silver gets a second headwind. So this isn't just silver versus silver. It's silver versus risk sentiment and silver versus the dollar. If DXY rips, metals usually struggle. If DXY rolls over, metals can breathe. So keep one eye on silver, one eye on DXY. This is a two-screen market. Here's the checklist for the next 24 hours. $90 is the line. Hold above $90 and bulls can regroup. Lose $90 and you open the door to deeper retracement. Watch how price behaves on bounces. Do we get weak bounces that get sold immediately? Or do we get strong reclaim candles that close above broken levels? Watch $94 from below. If silver rallies back toward $94 and gets rejected again, that confirms it as new resistance. If silver reclaims $94 and holds it, the crash may get labeled a liquidity event, a shakeout. Watch volume and volatility. A crash followed by shrinking volatility can mean stabilization. A crash followed by expanding volatility can mean more liquidation is coming. Watch headlines, but don't marry them. Markets overreact, then they correct, then they overreact again. The first reaction is rarely the final truth. Let's address the phrase everyone is throwing around, the deal that killed the rally. Whether the framework is real, finalized, or just a leak, the market traded it as real. And that's the key. Markets trade expectations. If traders believe the Arctic pressure valve is opening, the immediate fear premium comes out of silver. And fear premium is fragile. It's like foam on coffee. It looks big. It disappears fast. So if you were long silver purely because of geopolitical escalation, today was your wake-up call. That trade can unwind instantly. If you're long because of fundamentals, today is your reminder. You still have to survive the storms on the way to the thesis. Now let me pull you under the stage lights for a second, because the real violence happens where most people never look. Order books, derivatives, and forced flows. When silver runs hard, it attracts momentum traders and short-dated options. That creates a situation where the market is being steered by hedging mechanics. Here's the simplified version. Call buyers pile in during the rally. Dealers who sold those calls hedge by buying futures. That dealer hedging adds upward pressure, a feedback loop. But when price fails at a key level, like $96, that loop reverses. As calls lose value and traders dump positions, dealers unwind hedges. And unwinding a hedge often means selling futures. So you get a second wave of selling that has nothing to do with belief. It's mechanical. That's why flash crashes feel unfair. You can be right on fundamentals and still get steamrolled by flows. People love to scream manipulation every time a market moves fast. Sometimes, sure, big players push into stops, but you don't need a secret meeting to create a stop run. All you need is a visible cluster of risk. Stops are not hidden from the market the way people think. The market can infer them. If price has bounced 3 times at $94, everyone knows there are stops under $94. If price has printed a perfect round top at $96, everyone knows late longs are fragile. So when the headline hit, it wasn't one villain pressing a red button. It was the market doing what it always does, finding the weakest part of the structure and testing it. And the structure was weak because the rally was vertical. There are a few tells that separate a normal pullback from a liquidation waterfall. Today we saw all of them. Straight line candles with almost no bounce, spreads widening, meaning the cost to exit jumps, volume spikes at the lows, meaning forced sellers capitulate, a fast break of multiple support levels back to back. That last point matters. In a healthy trend, support breaks are slow and debated. In a liquidation, support breaks are not arguments, they're trapdoors. So if you felt like the market didn't give you time to think, that's because it didn't. That's what a liquidity event is. Let's talk about $90 like it's a courtroom. Above $90, the bullish case can still present evidence. Volatility shook out weak hands, but the bigger trend is intact. Below $90, the prosecution takes over. Breakdown confirmed. Supply of sellers is in control. Rips are for selling, because round numbers act like emotional anchors. Traders remember them, news headlines repeat them, risk managers build rules around them, and when a round number breaks, it changes behavior. That's why I'm not obsessed with the exact low today. I'm obsessed with whether the market respects $90. Here's a hard truth. Intraday drama is for retail. The close is for institutions. If silver closes the day with a long lower wick and reclaims key levels, that's evidence buyers defended. If silver closes near the lows, that's evidence sellers stayed in control until the bell. And if we see a weak close followed by a gap down tomorrow, that's when the pain spreads. So tonight, don't ask, did silver bounce? Ask, where did it close? Think of silver like a building with 2 forces acting on it. The floor is industrial demand. It's slow, structural, and hard to turn off quickly. The ceiling is fear premium. It's fast, emotional, and can disappear with one press release. During the last few weeks, both were pushing the price up at the same time. That's why the rally felt unstoppable. Today, the ceiling vanished. The floor is still there. But floors don't stop you from falling if you jumped off the roof with leverage. So the real question isn't, is silver bullish long term? The question is, how much of the last move was foam? If you're bullish, what do you need to see for the market to heal? You need structure, not vibes. Here's what that looks like. A base forms above $90. Price makes higher lows instead of lower lows, reclaims $94 and holds it for more than one candle. Volatility compresses instead of expanding. Headlines calm down and the market stops reacting to every rumor. If we see that, the bulls can regroup. If we don't, then this crash is not the end. It's the beginning of a larger unwind. And I have to say this because it saves accounts. After a flash crash, the mind wants revenge. You want to win back the loss. You want to buy the bounce aggressively. You want to short because it has to go lower. That emotional impulse is exactly how traders get chopped up. In this zone, patience is a weapon. Let the market show you its hand. Let it choose a direction, then respond. Because when volatility spikes, the market starts hunting impulses. Don't feed it. Print this in your head. Bullish recovery signals. Strong reclaim of $92, $93 with closes above. A clean pushback toward $94 on rising volume. Rejection of new lows, meaning sellers can't extend. DXY stalling or rolling over. Bearish continuation. Signals. Failure rallies that die under $94, a daily close under 90, rising DXY and risk on rotation continuing, volatility expanding again after a small bounce. If you track those signals, you won't need to guess. You'll see it. Today, the market traded de-escalation. Tomorrow, it could trade the opposite. Frameworks fall apart, talks stall, new statements hit the tape. And in a world where geopolitics moves price, the narrative can reverse overnight, so stay flexible. Strong traders don't marry stories. They date them, and leave fast when the story changes. Here are the three likely paths from here. Path 1, bounce plus base. We chop between $90 and $94, rebuild structure, then attempt another breakout later. Path 2, dead cat bounce. We bounce to $93, $94, fail, then bleed back toward $90 and possibly lower. Path 3, full reversal. We lose $90, momentum flips, and the market hunts lower supports until buyers step in with size. Your job is not to predict which path. Your job is to be prepared for all three. Today was the perfect storm. A crowded rally, a headline that pulled the fear premium out, and a technical trapdoor under $94 that turned selling into liquidation. If you remember nothing else, remember this. Markets don't crash on logic, they crash on positioning. Your edge is simple. Respect $90, track the close, and let the next bounce prove itself before you commit. Keep an eye on DXY and volatility. If both rise while silver fails $94, the path of least resistance stays down. A flash crash is the market's way of checking who is overconfident. It punishes leverage. It exposes crowded trades. It resets narratives. Today, the narrative shifted from fear is rising to fear is cooling. That one change was enough to rip $5 off the price in hours. So here's the closing question. Is this crash the end of the rally or the shakeout before the next leg? If you want my updated level map and the signals I'm watching into the next session, comment one word below, map. And if you want more breakdowns like this, fast, clean, and tactical, subscribe and turn on notifications. Stay sharp, stay liquid, and don't let the headline trade you.